Okay, now I've had the pleasure of seeing Mark speak a couple of times before, and I think he's going to make today's, what could be a fairly dry and depressing topic, actually a lot of fun. So I'm really looking forward to hearing from him. And as you'll have seen in his bio, he's done a lot of fantastic things. But one lesser known fact about him is that he is actually a friend of Nassim Taleb, and he proofread The Black Swan. So very topical, and he's obviously known the subject for a long time.
Is the mic on? Can you hear me? Yeah. I'm actually one of the few people that Nassim still talks to consistently. The secret for this is very simple. I also deadlift. That's that. So, anybody who knows the gag. Hello, how you doing? That was a bit heavy. Interesting, but very heavy. I'm the guy who usually gets brought to not to these conferences. I get brought to conferences that don't talk about this, and then I talk about this to try and get people to understand why it's important to understand this stuff. But this is the definition of coals to Newcastle, me coming to talk to you about this stuff. So we decided it'd be good at the end of the day if I ended up doing something else. So what we've got here is up there, that's it. Why do people believe stupid economic ideas? So there we go, despite buckets of evidence to the contrary. It's a line in my bio, and it's something I've been studying for about 25 years. I started off as an economist, and I got bored because I began to realize, A, I'm not really that interested in doing math problems all day. But secondly, the assumptions underneath the mathematics are incredibly heroic in some cases. And if you take this stuff seriously as kind of correspondence theories of the world, right, you're taking an awful lot of risk in that sense by believing this stuff. So I began to get interested in moving from there, how these ideas get off the blackboard and get into our everyday discourse. How do they get into public policy? How do they get into the heads of politicians? So that's what I got interested in. So the definition of a stupid economic idea is one that is immune to empirical refutation while being useful to specific constituencies. So what's a good one? So have a look at that slide there. That's real. Sovereign borrower of the year, 2007, the Hellenic Republic of Greece. Right, that shit actually happened, right? Now, I wrote a book in 2013 called Austerity, The History of a Dangerous Idea. You should all read it if you haven't already, it's a classic. And basically I got interested in this because the European Commission started to take seriously what I thought was the most stupid economic idea I'd ever heard of, which is called expansionary fiscal contraction. Now, if you're basically going to have the private sector deleveraging and the public sector deleveraging at the same time, and everybody's everyone else's trading partner, and you all use the same currency, then the only thing that can happen is you will have a contractionary fiscal contraction. But they began to tell the story that there was going to be an expansionary one. Now, the story behind this is brilliant. So that the everyday homily, of course, is the family budget and the state's budget. They're really just the same thing. So the family runs out of money, you stop spending, you tighten your belt, all that sort of stuff, right? And of course, the state's budget is completely different. Number one, families don't get to issue their own money. Families don't get to bring people into the family and then tax them for 5 generations. I mean, there's actually slight differences here. But the really big one on this is what I call the IKEA problem. And this is how, if you'd strip away all the econometrics of what this idea actually says, expansionary fiscal contraction. So you're in, let's say, Spain or Portugal. It's 2009, 2010. The economy's falling about your ears. You might have a job, but your wife works in the public sector, so you know that one's going. Now, in a micro level, you want to tighten your belt, right? Which, of course, if everybody does it is bad, because that's because there's the contraction. But you also know this idea called expansionary fiscal contraction. And you go, wait a minute, I just read in the newspaper that the government's going to slash the welfare state by 50%. Yes, this is perfect. See, using my rational expectations, I then calculate my lifetime income, given the fact that this credible commitment to cut the budget has now come out. Recalculating it in this way, I know that my future tax burden 25 years from now will be much lower than I anticipated. Therefore, I've got so much more money now, I run out to IKEA and buy a couch, so does everybody else, and we cure the recession before it starts. That's actually a real idea. It also informed easy policy from 2009 through 2011. That's one stupid idea. Here's another one, Japan. Eric Lonergan at M&G, some of you might know him, very smart bloke, produced these 2 little charts. Japanese public debt. It's terrible, look, 200, oh my goodness, blah, 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 it's the worst thing, and we're all going to go the same way, and it's all terrible, we're all going to die of debt. Forget, nobody's ever died of debt, but never mind. So anyway, they got 200. Well, it depends how you look at it. If you look over there, what you see is basically the government in Japan has been buying government bonds. So if you do a net calculation and then you look at how much of the issue since 2010 they've been buying, you drop way below 100 really quickly. And they're generating inflation. So why are they trying to do that when nominal GDP hasn't dropped and also the labour market is functioning relatively well? You're doing it because you're doing an intergenerational wealth transfer, because you've got an old society with too many assets and you want to basically burn those assets. Think about it this way. If I owe myself a mortgage and then I buy the mortgage back from myself, do I have any debt? The inflation puzzle. There's a fake king, Sweden. There's a fake economist, Milton. And why is it? It's a head fake, but it's a real fake. There's no inflation anywhere. We were all raised on monetarist theories of inflation. The 1970s is this very small n in the world, but we've generalized everything from. We were just talking about this. And it's very interesting. You've got 13 trillion in long-dated debt on the long end of the curve, 13 trillion in central bank intervention. And if you wipe the 70s out of your sample and go all the way back to 1350, I'll show you this in a minute, the long-run real rate of interest for the globe is about 1.5%. And what matters for inflation isn't money. Milton was wrong. It's labor power. Because if you have closed national economies and you have your own cash and you target full employment and you have strong labour protections, you will generate an inflation. You can get it through the import channel, Brexit's going to do that to Britain, etc. But the classic inflations in the 1970s come from a very specific institutional configuration which now no longer exists. So expecting some kind of mean reversal back to the world as it was, as produced by that regime, simply not going to happen. Now, again, who benefits here from this one? Qui bono, the question at the bottom, right? It's not clear to me who benefits from this one. But let's have a look at this. This is a brilliant chart, isn't it? So this is the very long run. So you go basically up to about 1550, and you've got financial instruments where there's no secondary markets. So you bear the risk. 100% is on you. There's no way of selling it out. Then the Genoese and the rest of it start to develop secondary markets. The interest rates begin to drop over the long run, and they're down and down and down and down. And then you see there's the 1970s. And we generalize everything. All of our ideas come from this one bit. Now, if I logged that out, you could see how long it would be and how insignificant in the grand scale of things that simple bit is. But have a look at the end of that series. Now have a look at this. There's the policy rates of the Big Four since 1980. That's not going anywhere, is it? And yet we're still waiting for inflation. It's like waiting for Godot. Now, what drives us to ignore falsification? First one, willful blindness. Dana Kahneman, thinking fast and slow. Heuristics, biases, we all have them. We can't cope without them. Great little trick to do with students is to give them a 2-variable problem to solve and then give them a 3-variable problem to solve that's relatively simple. They all swear blind, they're calculating, every single one of them is guessing. They don't even know they're doing it. Your brain's hardwired to trick you in that regard. Ideology. We can think of big ideologies, communism, all the rest of it. But there's also small ideologies. Economists have a particular ideology I like to call the market failure ideology. You see markets everywhere. So when something fails, it must be a market failure. But for that to be true, you would have to assume that markets are everywhere to start with. They're not. You just see it that way. But if you start to diagnose everything as a market failure, then there's specific policies that follow from that, which may be completely inappropriate to the environment you find yourself. Epistemic comforts of home, Russell Hardin. Why is it that in times of stress, in times of economic stress and political stress, issues such as immigration become politicized? Because we're hardwired to find the epistemic comforts of home. Group similarity. A little example of this. When was the last time football hooliganism was big in the United Kingdom? 1970s and 80s, the last big kickoff. I would actually put money on it starting again anytime soon. Because there's group identity under uncertainty. Again, you're hardwired to wear it. Religion. You don't think you're religious, but you are. Any Catholics here? The apostolic profession of faith is called the Credo, the Latin, which also gives us the Italian, credere, which is faith, which gives us the English, credit. Any Germans here? Was ist Schuld? Guilt. So the word for debt is guilt. The Italian word for it is credit. The English like to credit the Italians with inventing credit. You can see where this is going. It's hardwired into our language. And finally, there is the rational ignorance puzzle. Why would anybody bother to learn anything, given that most of the time we're wrong anyway? You can also be a muppet. This is a great example of being a Muppet. You can't really see the question up there. I'll read it for you. Which of the following is the largest? A peanut, an elephant, the moon, or a kettle? Apparently, in some quarters, an elephant is larger than the moon. We tend to assume not just that people are rational, that they have equivalent processing ability, i.e. there are no Muppets in the room. If there were no Muppets in the room, there would be no German Landesbanken. In 1954, John Kenneth Galbraith published his dissertation as a book. Many of you, I'm sure, have read it. It's called The Great Crash. Chapter 4, believe it or not, is called In Goldman Sachs We Trust. What was true then is true now. But in chapter 6, he has this wonderful discussion of what Scots would call talking out your backside, where basically he describes the phenomena of everyone buying stuff that nobody understands. But when that happens, everyone has an incentive not to be the person who points that out, unless, of course, you're Nassim Taleb. At which point, the whole world stops talking to you and thinks you're a jerk, even if you're right. Because the cost is the social cost of puncturing the bubble, which is more valuable than anything else. Second one, there's no payoff to calling uncle if uncle is the one with the cash. Classic example of this is you might be right, but as Keynes put it, the market can stay much more irrational much longer than you can stay solvent. So even ultimately, if you're right, it may not matter, because uncle has the cash, you don't. Perverse incentives. Upton Sinclair's fabulous quote. It is difficult to get a man to understand something when his salary depends upon his not understanding it. I believe that's called risk management in big banks. These are the Basel II things that they made everybody buy for no apparent reason, right? And now, thanks to post-crisis regulation, the biggest banks have the largest departments measuring stuff that fundamentally doesn't matter. And if you don't actually have it, it won't matter because it doesn't mean anything anyway. Now, what this also tells you about is institutional procyclicality in finance, or how to lose a good job in finance. So any of you trade those Russian bonds back in the 1990s, JKOs? Awesome. Did you short them? Did you get out? Good man. That's why you're still here. Because everybody else lost money. And the weird thing about your job is the following. It's weirdly procyclical. And it also leads to institutional memory problems, right? So think about the Russian JKOs. You offer 40% a forward contract on the ruble. They can't raise taxes. The country's run by a drunk, right? Why would you buy this thing? And yet, we invested billions in the whole thing because we thought I'd get our money back. Then the Russian court said, and then the Russian central bank said, and that was the end of the game, right? Unless you were on the right side of it and you saw that one coming. Now, if you lose money when everybody else loses money, you get to keep your job. If you make money when everybody else makes money, you get to lose your job. You do not want to be the person who doesn't take the risk when everybody else is taking the risk. Because the only thing that can happen then is a classic, to put it in your language, out of the money situation, where you're the guy who miraculously makes tons and tons of cash when nobody else does. Because the chances are, if you did the sensible thing, you'll lose your job. So everybody gets fired when the bad shit happens, and then nobody remembers that the Russians did what they did. When did the Russians get market access after defaulting on the entire West in the 90s? How many months later were they back? Exactly. This is a macro component, where I'm going to go next. Charles Perrow's written a lot about this, or he did the original book on this. The Space Shuttle Challenger is the classic case of this. It's called normal accidents. And basically, every bit of the engineering of the space shuttle was safe, because it was examined in individual parts. But nobody thought to look at the whole thing, and how the O-rings would integrate with this, and the nitrogen, etc., because it was no one's job to do so. So think about risk management as silos. Nobody looks at the whole thing. You might be looking at the whole portfolio, but if you misunderstand the portfolio, you don't even know what you're really looking at. So this is the harder stuff. Anything macro. Can you play that video, please? This is Daniel. This is not me. Daniel's at MIT. That's an MIT engineer's belly. Not mine. Deadlifter's belly. Now this is entrainment. This is a wonderful thing. Has anybody seen this before?
No, I'm at the back.
Oh, you're in for a treat. So all these, you basically set up a whole bunch of metronomes, and then, they're all out of sync. There's no way of syncing them. You put them on a board, stick them on a couple of Coke cans, and then this is called the gate. You go through the gate, and they all start to sync. It's the second order interactions of the energy of the component creating the system. That's the macro. That's the system. Now, you could have those sitting on the desk individually for a year, 10 years, a lifetime. They'll never sink. The minute you put them up there, they become entrained. But notice how fragile that system is. A little analogy here. That's Italy, that's France, that's Germany. The board is the euro. That's what entrains them all. And then when you try to change the Italian labour market, you're not just changing the Italian labour market, you're changing the dynamics of a system that you don't see and you don't understand. We're incredibly blind to this stuff. Now, take it off, guess what happens? Welcome to Brexit. You're going back to idiosyncratic risk. It starts to decouple. How cool is that shit? Can I go to the next slide? Yeah, well, sorry, back one. Play this video. Remember this one? The Millennium Bridge. This is awesome. This is exactly the same thing, only it's much more akin to what happens in herding and markets. So as you can see, there's too many people on the bridge and it's starting to sway. And then this sway gets exponentially worse. You've got an entrained, tight-coupled system. Now, how does it work? If you've been on the M25 anytime in the morning, this is what's going on. So some idiot brakes, and then you respond to the brake. The brake responds to the brake, and the response time declines as a function of the number of brakes. So everybody, in a sense, starts to walk in the same way. So the energy is getting transmitted through the bridge in exactly the same way. And the more that everyone tries to individually compensate for the move of the person in front of them, the more it feeds back and creates the entrainment, which creates the instability at a systemic level. Correlated indexes. Check this one. Over there, uncorrelated. There, what the hell happened? And then very tightly correlated all the way through. What happened in 2000? The entire world upgraded their IT kit. Y2K. You just created the board. You just created the Millennium Bridge. Now, tail risk and volatility. I couldn't resist it. I had to put in one slide. This is a newsletter that goes around the financially foolish. And it's great. I love this one. You'll spot the flaw. The flaw is in the title. Stalking the black swan. Right, yeah, okay. Short him immediately, right? Obviously, that's nonsense. You can't stalk a black swan. And as you guys were saying, if it's a black swan, you wouldn't know what to look for in the first place if you were looking for it. But would you play Russian roulette with a drunk Scotsman? Namely me. How many people would like to play Russian roulette with me? There must be a real risk taker here. Nobody? Well, imagine that we're going to. Chris, you're going to do it, right? Yeah, come on, just for a laugh, right? So imagine, though, that rather than, when I say risk to you, when I say Russian roulette to you, you probably have a mental picture. 6-chamber revolver. Now imagine that I've got private information that there's one bullet in 1 billion chambers, and you're going to get $100,000 a click. Are you willing to play? It's a structured product, right? Are you willing to play? Well, you won't go near it, you're a smart bloke, but many people will. And that's where fees come from. So imagine that you start playing this game and you start clicking, and you've done 1,000 clicks. You just made $1 million. This is fantastic, right? Now, implicitly, what are you doing? You're sampling and you're creating a probability distribution. And what probability distribution do we all implicitly have in our head when we think that we're dealing with neutral data, neutral data, neutral data, neutral data, neutral data? We're building a nice fat Gaussian. And we're looking for that expected mean and the mean to converge and all the rest of it. Unfortunately, you have no idea if it's 1 million from now or 1 from now that the next one's going to blow your head off. So apropos that structured product discussion, that's exactly the game that we're playing, and we do it all the time. This is a deep blindness to the endogeneity of things that comes from our inability to really see the macro and really see systemic effects. And apropos something that you wrote about Prisoner's Dilemma, is the whole world short vol? Yes, it is. Every time that I go in and look at my TIAA retirement portfolio and have a meeting with the guy who does this, which I just do for shits and giggles, basically. he has this nice little chart, and it's like, here's your small cap, and here's your mid cap, and here's your bonds. And I'm just sitting there thinking, going, the risk return profile given correlation is basically, this is all the same shit. It's all going to go up and down at the same point. This is a joke. Why are you even doing this? Because I find it fun. You know, that's basically it. People wonder why I drink. You know, there we go, right? So that's the macro story. Then there's a micro story here, which is, this is a wonderful Robert Solow line here. Everything reminds Milton of the money supply. Well, everything reminds me of sex, but I keep it out of the paper. Bob Solow did congressional testimony in 2010, and he was like 98 at the time, and he was still the sharpest guy in the room. And he was criticizing DSGE models in central banks. And he has this wonderful short paper, if you haven't seen it, where he says, here's what's wrong with the way that we model the world. We assume, in the central banking model, or the one that they use, that the economy is a person. And it runs through life optimizing. And we throw shocks at it. And we see how it does. And because of that, we decide on policies. It's really clever. There's only one problem. The economy isn't a person. And everything that we know about persons tells us that people don't optimize. So we have a model which is functionally useless, heuristically useless, and predictively useless. Everybody's still using them. Why? Because there's nothing else to use. It's a very human way to hold on to things. It's called the first law of wing walking. Don't let go of something until you've got something else to hold on to. But intellectually, this is complete crap, because until we had the rise of molecular biology, the number one theory linking genes and behavior was eugenics. Should we have stuck with eugenics simply because there was nothing else to hold on to? Probably not. But we don't like to. It's preferential attraction. And also the reality of too much information we need to process. So how do we cope with too much information? I love this slide. See it here. Boom, whoa, we should get inside. It's okay, lightning only kills about 45 Americans a year, so the chances of dying are 1 in 700,000. The annual death rate amongst those who know that statistic is 1 in 6. Welcome to conditional probability, right? So how do we deal with all this? We're crap. We can't see the macro. We're filled with heuristics and biases. We don't know information when we actually see it. Everything's much more correlated than we think. Systems are incredibly tightly coupled and entrained, and we can't see the coupling on the entrainment. That's the metronome example. What then do economic ideas do? They act as coordination devices. Basically, at certain points in time, we have a theory of inflation. We have a theory of market efficiency. We have a theory of X, whatever X is. And we can contest it, but it becomes broadly the framework that we all accept. That becomes incredibly important as a self-stabilizing device in and of itself. Because if we all had completely different, randomly distributed beliefs, it would be impossible for markets to function. So having these models, having these ideas, even if they're wrong, are actually important, because you can't do what you do when you bet against central banks unless you have an idea of what their DGSE models are actually doing. So as coordination devices, they're really important. If that's the case, take the next step. What we refer to as fundamentals are often social conventions. If you go back to the 1960s, 4% unemployment was regarded as insufficient progress. We needed to get lower than that. If you get to the mid-1990s, you had Alan Greenspan saying 4% unemployment is actually too little unemployment. We need more or we will have inflation. It's all context dependent. It depends on where you are in the cycle, which country you're in, which community you're speaking to. And at the baseline is that ultimately what these things do is they reduce uncertainty. In a very rough sense, what economic ideas do is allow us to talk a language of probability and probable risk in a world which is in fact deeply uncertain, because those conventions narrow the possibility set as to what we can expect, and that expectation is ultimately what you guys trade upon. But in using stupid ideas, we build entrainment and coupling volatility suppression into the system. And here's what I mean by this in closing. Here's how I think about the world. Again, this is why I drink. Now, have loose coupled systems, tightly coupled systems, low metronome entrainment, high metronome entrainment, right? So imagine a world after World War II. National economies, full employment targets, labor and capital, the whole nice thing, welfare states, high taxes transfers. They're very loosely coupled to each other. But as the world economy recovers, what happens, of course, is they become more tightly coupled to each other. Trade agreements, the GATT, etc. The world becomes more tightly coupled to each other. And if you target full employment, for example, for 30 years, Like any variable that gets targeted over a long time, people begin to game it. It loses its value. And what you ended up doing was producing a world where the returns to capital were asymmetric against labor, and capital defected. There was a system reset in the 80s. It was called Reagan, Thatcher, the whole lot. We also changed our economic ideas at that point. And we built a much more complex, but also loosely coupled system. Global markets, globalized finance, global supply chains, flexible labor markets. And over time, because of the very, very high spread that I started with, historical unprecedented interest rates, when you free the financial sector to do what it does, how do you guys make money on a decline in spread? You pump up the leverage. And as you pump up the leverage and you pump up credit and you have, what was it, 56 trillion notional in options, etc., then you've got a hell of a lot of compressed risk in that system. And in 2008, that system blew up. But there was no system reset. We bailed it. We let the central banks deal with it. And we've been engaging in a massive volatility constraint ever since then. And that is beginning to break down. That's populism in all its forms. Underneath this is a map of stupid economic ideas. Exactly the same. Phillips curve Keynesianism is a moronic idea. It was replaced by another moronic idea called monetarism. That was replaced by a really moronic idea called the Great Moderation, just before everything became very immoderate. And since then, we've been making up stuff like austerity, QE, and ultimately neo-nationalist Bannon-type economics. So in closing, I just want to suggest that nobody really knows anything, but you know that. We all fake it. But the fact that we all fake it in a common language means that we can partially create a world we can understand and trade in. And number three, we're so shit at seeing the macro. And ultimately, it's those macro and coupling dynamics that matter more than anything else. So if I can leave you with one thing, learn the macro. Bye. How are we doing for time?
Perfect.
Time for questions.
Great. So I was actually originally asked, the discussion with Catherine was, she saw me at Global Arc and I did a thing on Europe. She says, you'll have to come and do this. So I then got a title request, and the title said, it was a line from my bio, Why People Lose Stupid Economic Ideas. I thought, yes, I've always wanted to do this as a talk, so I wrote it up. I met Catherine outside, she's like, so you ready to talk about Europe then? I'm like, oh shit. So I hope that was okay. But I'm happy to talk about Europe, or anything else you want.
They offered you a job as the head of the European Central Bank. Would you take it? And if you would take it, what would you do?
I wouldn't take it. There's no way I would take it. What has happened in Europe is, you'd answer it in very, very simple with one question, right? What's the real yield on Spanish-Portuguese debt if QE stopped tomorrow, or on Portuguese debt if QE stopped tomorrow? North of I don't know. All that's happening is they've managed, because they're so bad on fiscal side, that they've managed to put all the weight on the monetary side. They did QE too late. The leveraging wasn't done through the balance sheets of financial institutions. It was done through the periphery economies, which is a populism generator. So you've created shitty politics. You've created massive fragility and entrainment in the system. And the only thing keeping it going is Draghi's bond buying. So if the job offer was be Draghi forever, which would be the true description of the situation they face, then I still wouldn't take it. But they've got themselves into a very difficult position. Now, ultimately, you know, German savers are complaining about the fact that they don't have their God-given right to 4% interest. But ultimately, that's not going to move it. Because I think everybody really knows that if they stop doing this, there's going to be a hell of a reaction very, very quickly. So he's trapped, so I wouldn't want his job, not for all the proverbial tea in China.
Do you want to comment on Scotland?
Oh, at the back.
Yeah.
It's the Optiver squad.
It is. So he's obviously trapped within the current politics and everything. Is there a solution? If we could clean sheet it instantly, there wouldn't be any political reaction. Is there an economic solution?
Well, you know, you could go back to that Bank of Japan slide, right? I mean, ultimately, there's a couple of ways out of this. You can just have a default. And in a sense, what the Japanese are kind of doing is defaulting on themselves very slowly without anybody noticing. So you can do it sneakily. That could work. What else could you do? Well, you can keep it going and actually encourage some kind of real positive fiscal response in countries that have adequate fiscal room, which is everyone in the north. The problem is they've developed an export-led growth strategy, along with the Eastern European countries, which is contingent upon sucking in demand from the rest of the world. Now, what that means is, and if you think about this in a national accounts term, if you're running a kind of currency area as a country that doesn't really have fiscal institutions, but you're running a surplus against the rest of the world, somebody inside has to be running a deficit. But in 2012, the European Union thought it'd be a good idea to write this pseudo-monetarist constitution where budgets have to be in balance or babies get killed and all this sort of stuff, right? So you have this fiscal sadism at the center, which means that you can't run that deficit. So essentially, what you're asking is the Eastern Germany and the North get to run a surplus against the rest of the world, and France and Spain and Italy have to permanently contract. So the solution is, it has to crack. There's a volatility suppression in Europe because of monetary policy, but there's also a political volatility suppression through these constitutional rules that make no sense. So it will break. It's just a question of when, and when it does, huge trading opportunities, but over time, it may actually be better. It's a bit like Brexit, right? Are the Brits going to be wailing and crying and eating dirt on the road because they're no longer members of the EU? I really don't think so. Right? Is there going to be a step function increase in the cost of living over the short term because of the import channel? Absolutely. Are the wings on the Airbus still going to be made in Wales? Yes. Are you going to move the Nissan factory to France? No, because you don't want to deal with French labour. Right? So those real factors actually matter, and real economies generate real wealth. To a certain extent, the entrainment is the EU itself. So the solution is to let the vol out, let it crack.
What do you think is going to drive the 25 plus here?
Oh, sorry.
Sorry. What do you think?
You didn't have a mic. I was like, how did you do that? So, is your voice like that all the time? That must weird people out. Sorry.
No worries. I'm channeling questions from the audience and from myself as well. One of them is, what do you think is going to drive the next 25% fall in equities?
That's a good one. I don't know. If I did, I'd already be prepared for it. It's not going to be Trump. I don't think so. I don't think Trump makes the world as risky as people would like to think Trump makes the world risky. What we're seeing is the way that American institutions actually are very well designed. I've been there for 26 years. I'm a US citizen. And when you get there, you got all this kind of guff about the genius of the Constitution and the Founding Fathers and the HBO series on John Adams, which is actually really good and worth watching, right? But then in these moments, you begin to recognize that the checks and balances system is actually kind of special. That he really actually isn't able to bulldoze through a lot of stuff. And that gridlock is actually sometimes an optimal policy. So, you know, that doesn't worry me that much. What worries me is foreign policy risk and miscalculation. What worries me is what happens with North Korea. Because no American president, regardless of whether you're Trump or not, can actually allow ICBMs from basically President Twinkie, who's on crack, to reach the west coast of the United States. That's just completely unacceptable. So there will be a showdown there, and it's that type of geopolitical stuff that I think would drive those types of falls rather than anything else.
Yeah.
Cocktail recipes? Anything else? No. I like Green Points. Green Point's my new favorite cocktail. When you go to the bar tonight, try and remember this one. 2 ounces of bourbon, half an ounce of yellow chartreuse, half an ounce of sweet vermouth, orange bitters, Angostura bitters, stirred up. Beautiful.
On that note, views on Scotland?
Views on Scotland. It's a nice place to visit in August. It rains the rest of the time. Haggis isn't nearly as unpalatable as people say. And I understand why they're going to go for it, but the thing is they don't have the demand for it. This is the weakness in it. So the way the SNP look at this is as follows. Brexit's going to be awful. It's literally going to be the wailing and gnashing of teeth. Sulphur will rain from the sky, the whole lot. Because Scotland lives off of huge transfers from England. The English economy, I think, is 11 times, 12 times the size of the Scottish economy. So Scots get about $2,000 a year, basically gratis and extra public spending. Now, the Scots are legendarily unhealthy, right? I mean, we are just horrible, right? We are top for lung cancer, bowel cancer, everything, like world champions. We're number one, right? So we're old, we're inefficient, we're all lefties. We love risk redistribution so long as somebody else is paying for it, right? And what they fear is Britain's adjustment strategy, in extremis to Brexit, is going to be to basically build Latvia with airbags on a much bigger scale with a giant financial sector. And that means all those nice transfers die. So the question for the Scots over a 10-year period is, do you want to own the pain? And 10 years from now, you might get somewhere? Or do you just want to have someone screw you for 10 years and you're still, at the end of it, dependent on their whims? So they want to take the first option. The problem is this. Go back to the referendum of 2014. All the old people have assets. This is true globally. Baby boomers have 80% of all financial assets. And there's an 80-20 split, as there is in most inequalities. Guess what? 20% of the boomers have 80% of those assets. And this is even true in Scotland. The old vote twice as much as the young. They're not going to vote for new pounds. They're not going to vote for kilt-edged securities. They're not going to vote for devaluation. So they're going to stay in, and the old people will win, as they always do, which is why the boomers are the greediest generation. But that's the title of my next book.
Okay.
On that note, what about the German elections and French elections?
French elections, we're probably going to get away with it, but it's underpriced for one simple reason. You can do all the stats and estimates and polls you want. You don't know turnout. And at the end of the day, you're asking the French Catholic right and the communist left to get up on a Sunday morning, embrace arm in arm, sing Kumbaya, and go vote and go stop someone who, particularly for the left and the young, their policies are actually appealing. So I think there's a lot there that's kind of could be mispriced. The German election, the best thing that could happen is that Merkel steps down. I know this is an unpopular view, but essentially you need to break the way that Germany treats the rest of Europe as a kind of balance sheet problem and an accounting problem. And she stays, Schäuble stays. If Schulz gets in and you have the possibility of red, red, green, you really could do a lot to transform what's going on in Europe. So best thing is that, you know, it's been great, Angela, but it's time to go. That's pretty much it. Unfortunately, that won't happen. You'll probably get a Schulz winning marginally, and then you'll have another grand coalition, and sod all will change.
A final question from me, if nobody else has another one, is what does it take for us to unlearn what we know already to be able to react in the way?
Huge quantities of alcohol. That's a start. That's a start. No, the serious point is, and this is something I think, talked about him earlier, I think this is something Taleb actually tries to do in his life, ruthlessly. And he does it by calling bullshit on everything. Unfortunately, he thinks everything is bullshit, right? But it's to be ruthless with the truth, right? There's lots of things about ourselves, about our families, about our relationships, about our politics. We're all hypocrites. We're all contrarians. And we need to learn that that's the truth. Otherwise, you can't really see the information for what it is. Let me leave you with a story about this. The second time I was in Australia, an APEC summit was on and George Bush was president, so they shut down the whole of downtown Sydney. And I was meant to go up to the university, which is up the King's Road, and I had to take this huge long route. So I get in the cab, and it's this Lebanese Australian taxi driver. And he's like, oh, where are you from? I just came in from America. You fucking Americans! And he let go. I mean, he just went mental, right? So it was like left-wing abuse just going on in the car. You Americans do this, you run the world, you're a bunch of this, blah, blah. You know, I've got a Scottish accent, it doesn't stop him, right? Just, what? So he's just giving me shit as sort of like only angry Australians can. So after about 2 miles, I stopped at a traffic light. And I looked at him, and he's looking at me in the mirror. And you know when someone's got angry eyes? You know, so can I ask you a question? Yeah, what is it? Aren't you the country that voted for Howard 3 times? The little shit that would basically get down on his knees for George anytime he asked for it. Isn't he the guy who cut taxes? Isn't he the guy that said that you would go to Iraq? And I went through his accomplishments. I'm sitting at the lights. He doesn't say anything. Puts the car in gear, drives off. 3, 2, 1. You know why that is? Why? Because we're a nation of hypocrites. And he kept driving, didn't say another word to me until they got to the top. And I got out of the car and said, that's the only true thing you said this morning.
Cold, I guess where I'm from.
Where are you from?
Yeah.
Where?
Lebanon.
I was about to say, because if it's Australia, I've done that joke. Are you from Amayun?
From?
Amayun, where Taleb is from?
No.
No?
I'm not sure where it is exactly.
It's right on the
I
north.
grew up between Lebanon and Switzerland, so some of the countryside I'm not familiar with. But
Excellent. Rather different places. Both of them
Yeah.
good at hiding money.
I know Thank you very much. Anyway, that was great. Thank you very much.
Thank you.